The Echelon Radio Network presents the Tax Matters Radio Podcast, a conversation about money for everyone, with your host, Gary Weiss.
Welcome to the Echelon Tax Matters Specialty Group Podcast. I'm your host, Gary Weiss. Why should you listen to this podcast? Because it's fun, informative, and easy to understand, and you'll have the best time. In the interest of full transparency, I am a licensed CPA in California since 1996, and I practice in Woodland Hills with my partner, Quentin Staples. I also specialize in tax resolution services, hence my tagline, I fight the fascist state of California and the evil empire known as the IRS. Today's guest is Frank Taylor, representing Frank J. Taylor Insurance and Financial Services. Very exciting. Frank, welcome to our podcast.
Thanks, Gary. Glad to be here.
All right, begin by telling the listeners a little bit more about your background, you as a man, where you came from, and sort of how you got into the topic of the day, which you will reveal shortly.
Well, I was born and raised in Los Angeles. My parents, my mother came from Tennessee and 1 year old because my grandfather died in the great Spanish flu epidemic, and the family migrated out here. And my father was raised in Portland, Oregon, and they met at a Stanford weekender with USC in football. And father came down and married, and here I am. I have two brothers, and I myself went to USC, played volleyball there, stuck around and got my MBA, and had several different jobs in management, and figured out that I really wanted to be my own boss, and I liked to taking care of people.
First of all, let me congratulate you on choosing an excellent school to go to, because we know that's the real school in Southern California, as opposed to that other one in Westwood someplace.
Yes, I figured that out too. Thank you.
All right, go on.
So met a man who was just a few years older than me, raised also in Hancock Park, that was running one of the large insurance agencies out there in the life insurance business. Talked about the opportunities, and that based on my background, that there was a lot of people that I knew that I could help and take care of, and also support my family. So I started with that company. I was semi-independent, and they also provided training for me, which I think is very important, because in your business, would you rather have a bookkeeper take care of your taxes or a CPA? In my business, would you rather have someone who just has an insurance license or someone who has a chartered life underwriter designation known as a CLU? So I got the CLU designation, also the Chartered Financial Consultants designation, and was one of the first people around to get a long-term care designation, a CLTC, over 20 years ago.
Excellent. So I'm curious, though, in school, what was your major in school?
I was actually an architect major the first 2 years, and they have a great architect school at USC, but it was changing deans, and it got so way out there that people were designing eggs to live in, and I went the more practical route and transferred over to the business school.
Yeah, it sort of cracks me up that they would do that. All right, so So then after you decided to change, where did you go from there?
Well, being with the insurance agency that I was provided great training, and then I used a lot of social circles that I was raised in. Went to school on the west side at Palisades High and had a lot of friends there. I was a Sigma Chi at USC, had a lot of friends there, which is one of the big advantages of going to a place like USC. And I also was raised at a beach club. It's where I learned to play volleyball, and there were a lot of people there that were fairly affluent and would agree to talk to me for a few minutes, and there we would go.
No, so your volleyball career sort of launched you into the insurance business?
Well, yes and no. It helped at the club, working with volleyball players on the public beaches, which I carried a beach range for over 20 years. There wasn't a lot of opportunity on that end.
Oh, I bet there was, and I bet you got some great stories for that, but that's for another time. So let's keep going on. So what is your topic of the day that you want to talk about?
Well, I'd like to talk about the need for long-term care.
Okay.
One of my fortes when I was younger was selling disability insurance, because I knew that there were 3 times greater chances of someone getting hurt or sick as opposed to having a premature death. And so I would take care of our clients with not only life insurance but also disability insurance. I didn't care if the life insurance was whole life or term, just so they were fully protected, because if, God forbid, tragedy happened, I wanted to have the right coverage for the individual and their families.
Yeah. So you have long-term care and you have short-term care, and there's all sorts of insurances. Can you briefly describe what's the difference between those two, and what's the target market for short-term and long-term?
Well, there's not really a target market for short-term. Typically, if you have a long-term care need, you're going to be laid up. Typically, the average time is 4 years. Now, I got into the long-term care market as my clients got older, and this became more of an issue. But the thing that was more troubling is that my mother came down with Alzheimer's. And although my father had died of a sudden heart attack in his 80s, had prepared to take care of her when he passed away, the look in her eyes when she was worried about what was going to happen to her when she was first diagnosed with the Alzheimer's was just really troubling. And I knew there was a solution to that, taking care of people, and that's doing a long-term care policy, which had just started to become popular out there. So it was an easy transition for me, who sold a lot of disability insurance, to move over to the long-term care. It is different than disability. There's a government definition that is standard for all the tax-qualified policies out there. So that was fairly easy to relate to the clients, but the need was more important. Typically, the people that are most interested in buying the product had the same situation I had, parents that were having health issues and they weren't sure how to take care of them, and they did not want them to be wards of the local government or the state.
So for long-term care, who really needs long-term care? When should they get it? What's the best time? And define, you said like 4 years, but what's really the need? Who really needs long-term care insurance?
I would say just about everybody out there that can afford it. It's not inexpensive to buy long-term care. The government does have a policy out there, if you're on Medi-Cal, that'll help you if you have to go to a facility that they are involved with, which may or may not be to your liking, or in an area that's convenient for your family to see you. What's happened over time, though, Gary, is that the typical long-term care policy is going away. The companies that have issued those in the past have had severe economic downfall on paying claims because they just didn't understand the market. They didn't realize that people were going to live longer, which brought in dementia into the equation. Half the claims now are for dementia, severe dementia. And they also did some other pricing inaccuracies, the actuaries did, which caused them to have higher claims. People that buy long-term care insurance do not lapse their policies. The actuaries assume that there'd be a 4% lapse ratio. I don't want to go on that tangent.
It's way too complicated.
But the point being is that they blew it. And now it's very hard to find that policy. What's becoming more and more popular is what's called a hybrid, which brings in younger people into the equation now. You buy a permanent life insurance, whether it be a universal life or a whole life, and you attach a long-term care rider on that policy, which allows you to take money when the need comes up. Hopefully it's not till you're in your 80s, but there'll be enough there to take care of home care or assisted living care. It will lower the life insurance benefit. That's how the insurance companies can protect their backside easier these days. But it also has the advantage of using that money on a tax-free basis.
Okay, so you brought up an interesting point. Home care versus assisted living or outside of the home care. How does that work, and how do you recommend which they should do, and what are sort of the criteria around using either or?
Most people do not want to go into assisted living care if they can help it. Some people may be single and maybe they feel that's the best option, but they'd rather have someone there at the house to take care of them. The definition of being eligible for a long-term care claim is the same for both. There's something called activities of daily living, which if you are unable to perform 2 of the 6, they're physical activities like, can you prepare your breakfast in the morning? Can you go up and down stairs? but it also gets waived if you have severe dementia. So it's really a choice of the family and the individual if they are going to have home care or go to an assisted living facility.
Okay. So, as a professional, and as I've got to know you, a caring man, when you deal with, when the people get in their 80s and they find themselves in that position, you have to fine line, because you have to deal not only with the policyholder who's now entering dementia or is in dementia of some sort, but you have to deal with the families. Tell us about how you deal that.
Well, the families, of course, want to make sure that the claim is going to get paid by the insurance carrier. So although the insurance companies get a little edgy when the agents get too much involved in the paying of claims, I can advise the client, this is how the policy is paid off. I can't approve the claim, but this is what they're going to ask, and they're going to want a doctor to verify it.
Right, but when the families come to you,
yes,
and they go, "Hey, Frank, my mom this, my mom that, or my dad," and they go, "What do I do?" They start to panic. How do you deal? How do you treat the family? What's your interaction with the family personally?
I try to give them peace of mind that we're going to do the best we can in taking care of their family members, be it a parent or even a sibling, and that if they have any questions, we'll do our best to answer them up to a certain point, and try to assure them that things are going to work out okay.
Okay, so legally, if a person becomes incapacitated mentally, a lot of times that requires a conservatorship or intervention from the courts or a third party. Do you work with attorneys and the family to help that?
No, unfortunately, I'm at a position that I would be violating my relationship with the insurance carrier if I got too involved in that respect. So
if the family comes to you, you say, "Hey, look, you got to talk to your attorney. Get the doctors involved. I can't do that."
Well, I can give them some ideas of what to expect, but making promises, no, I can't do that.
Got it. All right. So that's real important. How when families come into this state, especially if there's a lot of siblings and there's extended family, this can become very disruptive to everybody's lives. It's amazing how one person can cause ripples throughout the family of disruption. So in that happens, how do families, what do you recommend to families that are all of a sudden their lives with the flip of a switch are turned upside down? How do you help them navigate that, and what is your job as an advisor in that capacity?
At the time of the claim, it's a little difficult based on on what my contractual obligations are with the insurance carrier. But the good news is that it's a standard definition with all the carriers of how they will collect on the claim. And assuming the claim is legitimate, and almost all are, it really comes down to the doctor and what the doctor's report's going to say in order to approve the claim.
Okay. So when this happens, the families, what I've learned is a CPA, because a lot of times I will get involved, I'll become part of a team. So when you see these happening, even before a claim's filed, but you see it coming, they come to you and say, "Hey, Frank, you're my really good friend. My dad can't find his car keys 3/4 of the time, and they're right in front of him." If this is the time when you need to start forming that team, so that the transition, when they have that time comes and they need to be put into a facility or need the long-term care, who is that team? Who do you recommend that they put as a team together?
Well, their CPA is an obvious one. If they have a trust that's involved, the trustee needs to get involved. The family attorney probably wants to be involved as well. And then it's smart to have communication with all the family members, but unfortunately that ends my duties as what I can do in terms of helping that, because if I say the wrong thing and a claim for whatever reason is denied, they're going to fall back on me, and then they're going to go to the carrier saying I should have known better. And so I try to help, but I do have limitations.
Oh, absolutely. And that is the purpose of having a team, where one person has to stop, another person can start. Just a note for all the listeners, and I do this in my practice with my clients. The trust. Frank mentioned a trust. This is one of the most important documents that every family should have. Trust is not just about avoiding probate. It's when things like this happen, when people become incapacitated. Who takes charge? Who makes the decisions? Who makes the medical decisions, the financial decisions? This is a real important thing that all families, whether you have wealth or not, but you need to understand that there's that during that transition when we're talking about, it can be chaos. And all of a sudden, everybody doesn't know what to do, or everybody knows what to do, and everybody has an opinion. So if you have a living trust in place, that is what it's referred to as a living trust. It has things like durable power of attorneys for healthcare and financial matters, which will help in that transition. So if you are listening and you don't have a living trust, get one. Get to a trusted trust attorney and find yourself and get one today, because as Frank's saying, that's an integral part of the team, is not just the attorney but the trust itself. So there's essentially a pathway, way that's been predetermined, so that person isn't left out, having possibly third parties make a decision for them. Would you agree with that?
You certainly don't want the courts to appoint someone to control your parents or perhaps your estate on what's going to be involved in your care. That trustee is really important on who you choose. A lot of times people will pick children. My only recommendation is stay with one child. When my mother-in-law passed away, in order to placate the family, they had two trustees, and it was difficult getting decisions done with the two children. They both had different ideas. My wife was one and her sister. So if that person's not around, or if a trustee, that's the other thing too, is you have to be aware of how old the trustee is when you put that into place. Over time, you may want to change that trustee. If you're not sure or have anybody around, there are professionals out there that will be involved, and there are professionals that are involved in healthcare and taking care of the seniors when they are involved with long-term care needs.
Oh, absolutely. One of the most important things in having a living trust, and I have clients who have them, that they formed them in 1969 and haven't changed, and the laws have changed, the tax laws have changed, a lot of stuff has changed. It's imperative that every few years you take it out, read it, see if it needs to be changed, amended, or updated. That's very essential if you want to protect your assets and protect your loved ones.
Well, that's true. I probably should be redoing my trust, because in the meantime, when I first did it, I've got a fairly substantial pension plan out there that may be subject to probate because I don't think it's in the trust. And I'm going to take care of that right away. Right.
That is one thing that living trust to avoid is probate. But let's go back to insurance, long-term care. We were talking about probate, and we're talking about trust and everything. What happens when that person with dementia does pass on, and there's these insurance policies, or there's long-term care policies, and there's leftover bills? Who takes care of all of this?
Well, when the individual passes on, and again, unfortunately, the typical long-term care claim is about 4 years. If there's still bills being paid, it'd be pretty much up to whoever's handling the estate to settle with the insurance companies on the final bills.
Okay, so they take care of that. And then there's beneficiaries for insurance policies. So they have an insurance policy, life insurance policy, and then the client comes to you, or the surviving child comes to you and says, Frank, my parents said that when I die, I'm going to come and talk to you. So they come and talk to you, go, what life insurance policy? Who's the beneficiaries? How do they get paid? Is it taxable? Out start coming all these questions that they didn't understand and nobody wrote down. So how do you advise them? What are sort of the basic rules with life insurance payouts, policies, and that kind of thing?
Life insurance benefits are tax-free. Why? Because in almost every situation, you have to pay with an after-tax dollar. And so based on that, when there is a death benefit to be paid, that money comes tax-free. You do have to be careful over time if that policy is transferred around. If a business has it and they transfer it to another business, it could cause a taxable event. So we try to advise our clients on that as well. But the typical life insurance policy is going to come tax-free. If you're receiving disability insurance, you typically would pay that with after-tax dollars. That benefit's going to be tax-free while you're on disability. And the same with long-term care. That's tax-free. But we also advise our clients, if they buy a policy, there are some tax advantages where they can write off the premiums on a long-term care policy where they cannot on a life insurance or disability policy.
All right. So I always advise my clients, if they're buying a disability policy, don't deduct it. Because if you deduct it on your taxes, then the benefits, as I understand them, become taxable. If you don't deduct it, you pay it by yourself or after tax dollars, and you don't deduct it anywhere, then those benefits are not taxable. And I have one client that was a photographer, and he ended up collecting. He had a damage to his hands and couldn't hold a camera anymore. Over time, he collected $84,000 in tax-free benefits. So, again, before you purchase long-term care insurance, short-term disability, long-term anything, when it comes to this stuff, seek an advisor who is well-skilled in this, like Frank. Right, Frank? Because I think you're going to say, hey, let me tell you how it really is, not what you heard from your brother's, uncle's, gardener's best friend.
We handle a lot of small businesses and their owners, and there are tax advantages when they bought the long-term care. Now, they are out there, those standalone policies, but depending on what the entity is, will determine if the client can write off the premium to pay for that long-term care for them and their spouse. If you're a sole proprietor or an S corporation, a partnership, there's going to be a scale that's going to dictate what you can write off through the business. They'll pass the income that they paid. It'll be passed down to the individual, and then the CPA will write that on their personal tax forms and take the deduction off of that. But, for example, if you're over age of 50, you're going to be able to write off about $1,800 a year of premium for you and another $1,800 for your spouse, assuming that they've bought a policy as well. But then it jumps to when you're age 60, that write-off jumps to about $4,800 per person. And that should take care of most premiums for any long-term care policies. Now, if you're involved with a C corporation and an owner, they can write that whole premium off. And if the C corporation is you're an employee there, they can purchase that policy for you and write the premiums off as well. So there's a lot of good advantages there.
Oh, so if anybody's interested, when Frank says a C corporation versus an S corporation, best thing to do is give myself a call or give Frank a call, and we'll explain to you the differences. So before we end our exciting journey here, just give us a little bit more about you. How many kids do you have? What are some of your passions in life? What do you like to do?
Well, I obviously still play volleyball. I play on Saturday mornings when I'm in town. 10 years ago, I bought a house up in Lake Arrowhead, so every other weekend I'm involved up in there and hiking trails and living the good life. And lately I've been shoveling snow. I have 3 children, two sons and a daughter. One son is involved in the high-end furniture business. The other son works for a company that distributes and ships wine up in Northern California. We just were up there a couple of weeks ago to see him.
Nice job.
Yeah, my little girl, she's not so little. She's 6'3", and played volleyball in college, indoor and beach volleyball, and is a beach volleyball coach for high school.
Very nice. All right. So for our listeners, why don't you tell us how they reach you, who you are, what your website is, where you're located?
Well, again, I'm Frank Taylor. I go by Franklin J. Taylor Insurance and Financial Services. We're located in Sherman Oaks, California. We do have a website, www.franklinjtaylorinsurance.com, and our phone number is 818-990-0446. That's 818-990-0446.
And your website?
It's Franklin J. Taylor Insurance.
Excellent. All right. Thank you very much. Well then, intrepid listeners, this is all the time we have for today. I would like to thank my guest, Frank Taylor. Please look forward to future podcasts right here, same bad time, same bad channel. I guarantee you will be entertained and enlightened at the same time. I'm your host, Gary Weiss. I look forward to spending time with you on our next Tax Matters Specialty Podcast. Y'all come back now. You hear?
The Tax Matters Radio Podcast.
Presented by the Echelon Radio Network.
And Echelon Business Development.
More than just networking.
Way more.